Hello and good morning, everyone. Welcome to Almus Market Mornings, your daily dose of financial updates with me, Swaraj. I have our market expert JK with us, who will be taking us through the latest developments for the day. Now, we have seen the US indices correct sharply yesterday. S&P 500 plunging 4%, which is the highest daily drop in almost 2 years. JK, what's going on with equities and what other updates do you have for us?
Good morning. So the fear of inflation and high interest rates come back to haunt the markets once again. And that has been accentuated by some very poor results from retailers in the US. In fact, yesterday we had seen inflation numbers from EU, then UK and also Canada, all hitting new cycle highs. And that confirmed to the market that central bankers will be fighting the inflation with the high rates, even at the cost of slowing down the economy. And that has been reflected in the stock market sell-off. In fact, the rally that started early in the week was killed after two big retailers, Walmart and Target, reported big come down in their earnings, and that was almost close to what was seen in 1987, bringing back memories of the Black Monday. Of course, it has happened on Tuesday and Wednesday. It has shaken the investors, and now people are convinced that it will be a long time before the inflation is checked and the financial conditions ease out. Most in the market also believe a recession is inevitable, and therefore the stocks are going to underperform for quite some time. Of course, stocks have now been vigorously pricing in a new era of high inflation and high rates, not getting a sense of when the worst will be seen. But interestingly, S&P 500 is now trading at around 17 times of expected earnings, its lowest PE valuation since 2020 sell-off after the pandemic. But very difficult to see big bargain hunting coming in until we see some definite signs of peak in inflation and get a sense of where the terminal rates would be from the central bankers. So that is stopping the market from gaining further. On the currency front, of course, market is back to buying the dollars as a safe haven, with intensifying the risk aversion and giving thumbs up to the Fed, who is seen far ahead in fighting inflation. Powell, in fact, said on Tuesday that US central bank will raise rates as high as needed to kill a surge in inflation that threatens the foundation of the economy. Market is also expecting the terminal rate of Fed to be around 3.5%, and hence they are comfortable in buying long bonds at 3% yield, moving away from stocks which are losing heavily. The benchmark 10-year bond yield is now 30 basis points lower from the peak of 3.31 seen early in this month. Yen, of course, gained as the US yields dropped, and also there are indications that some of the corporations in Japan are complaining about a weekend affecting their businesses. In fact, we have a G7 finance ministers meeting going on in Germany right now. It ends tomorrow. While the agenda does not indicate any discussion about currencies, one cannot rule out some sort of the sidelines, on the sidelines, some talk about the extremes of the currency moves. Particularly Europe and Japan are concerned about the one-way moves in their currency, which is likely to threaten stability. So we might see some hints of what the G7 agrees on the currency. So that's there. The dollar is still strong, but we are still not breaking the 105 key level on the dollar index and 1.0350 on the euro. These levels hold the clue for next direction on the dollar. Right now, there is no hint of a change in direction as far as the dollar is concerned. On the rupee front, of course, we had a relatively quiet 2 days, but it's probably likely to be stirred up again, volatility today, because global markets are down. Indian indices is looking like opening around 2% down, and FI numbers are once again in the negative. wholesale price index at 17-year high, at 15.08 versus 14.48 expected, which was announced day before yesterday, is giving rise to expectations of another rate rise in June. More importantly, the minutes of RBI's MPC released yesterday shows a near unanimous approach of members to fight inflation. Governor Das said that they were not ready to wait till the next scheduled meeting, as the war-related inflationary pressures were accentuating. And one of the members, Mr. Jayaram Krishnamurthy, even opined that more than 100 basis points of rate increases were to be carried out soon, and preferred a 0.5% increase in June. So overall, the outlook for the rupee is still one of weakening, although, as we know, the weakness is not at a pace that the market looks for, because RBI is persistently there to sell the dollars and bridge the gap between demand and supply. So we have many challenges. Fiscal challenge, because rate hikes will lead to higher financing cost for the government, and then inflation, trade deficit. None of these challenges are going away in a hurry. Therefore, even if we do see a retracement in the dollar index, I think INR will take some time to catch up until. Now, I think the key will be how the oil behaves in the coming months rather. We are, of course, in a virgin territory for the USD, and we will probably break the 77.80 level, which was held a couple of days back by RBI selling. If we do, then the next hurdle to the dollar will be at the psychological 78 mark. Still looking for a gradual, measured depreciation in the rupee versus the dollar. Thank you.
Okay, that was wonderful, Jayaram sir. And as we are seeing, the inflation fears are back, which have caused the equities to give up all its gains which it had built during the week. We are expecting a volatile session for rupee today, and as we saw, Jayaram sir mentioned, yesterday's MPC minutes show RBI is ready to fight inflation, and it will not wait for a next scheduled meeting. So it's so important to manage our risk. That's it from our side. We'll come back to you with the latest developments tomorrow morning. Thank you.